Welcome to the Bullion Signal Podcast, the channel where we cut through the noise to understand the powerful forces shaping our financial world, especially in the realm of precious metals. Today, we're diving deep into a battle that's raging just beneath the surface of the silver market. Now, this isn't about the little up and down ticks you see on your screen every day. No, this is something much bigger. It's a fundamental conflict, a showdown between the physical silver you can actually hold in your hand and the complex world of paper contracts traded on Wall Street. It's a clash that, frankly, could challenge our very definition of what real money is.
To really get a grip on why this is happening now, you have to zoom out and look at the big picture. And that big picture is dominated by one staggering number: $38 trillion. That's the approximate national debt of the United States alone. We are living in an era of unprecedented debt, a world literally drowning in paper promises. And when the value of that paper money comes into question, people, smart people, start looking for an escape hatch. They start searching for something tangible, something real. And that global search for safety, well, that's the fuel for the irresistible force we're about to explore.
And that leads us to what might be the most important question of our time. In a financial system that is built almost entirely on layers and layers of promises, where can you find true, tangible value? For a growing number of people all over the world, the answer isn't another stock, another bond, or another digital token. It's in something ancient, something you can touch and hold, something real. For them, the answer is physical silver.
And this right here, this is the heart of the story. It's what we're calling the silver paradox. On one side, you have this incredible, almost frantic demand for physical silver coins and bars coming from everyday people. Think of it as Main Street screaming for the real thing. But on the other side, you have the paper price, the one set by Wall Street, that just seems to defy gravity, staying mysteriously contained. It is a classic standoff between physical reality and financial engineering. And you know, in any standoff like this, eventually something has to give.
Okay, so let's break this whole thing down. We're going to look at both sides of this equation. First, we'll dive into that irresistible force, the staggering physical demand. Then, we'll examine the immovable object, that powerful paper market structure. After that, we're going to investigate a very mysterious event, a shutdown at a key exchange that has everybody talking. We'll explore the two completely different stories that have emerged from it, and we'll wrap up with the one final question that will ultimately determine the future of silver.
So, let's start with part one, that irresistible force. And I want to be clear, this isn't just a gut feeling or some kind of speculation. We're talking about a raw, overwhelming, and totally quantifiable global rush into physical silver.
This quote from a bullion dealer in Singapore really says it all. In any normal market, for any normal product, when the price goes up, demand is supposed to go down, right? That's Economics 101. But that is not what's happening in the physical silver market. Here, higher prices are acting like gasoline on a fire. The price goes up and it just pulls in more buyers, accelerating the demand. It's a complete inversion of basic economic logic, and it tells you that something very unusual is going on.
And this isn't just anecdotal. We have hard numbers to back this up. That same dealer reported a staggering 84% surge in physical silver sales in just 1 week. And that was with 3 days still left to go in the week. This isn't just a minor uptick. It's a verifiable buying frenzy, a stampede into the physical metal.
So what happens when you get this kind of buying fever? Well, you get a massive disconnect between two prices. Think about it like trying to buy tickets for a championship game. There's the official face value price, printed on the ticket. But then there's the price you actually have to pay a reseller when everyone wants to get in. That difference is the premium. The same thing is happening in silver. You have the official spot price on the screen, and then you have the much higher price people are actually paying to get a physical coin or bar in their hand. And right now, those premiums are screaming that the official price isn't telling the whole story.
All of this brings us to a really critical question. When the physical reality, what real people are willing to pay in the real world, becomes so detached from the official paper price, it creates a very tense, very unstable situation. You have two different worlds operating by two different sets of rules. So the big question is,
can a situation like this really last? Or is something about to break?
Okay, now let's flip the coin and look at the other side of this battle. If the incredible demand for physical metal is the irresistible force, then the paper market is the seemingly immovable object, working tirelessly to contain all that explosive energy. You know, one analyst described the price action perfectly with this metaphor. He called it the beach ball underwater effect. Imagine you're at a pool trying to hold a big inflated beach ball completely underwater. You can push down on it with all your might, but the ball's natural buoyancy keeps fighting to shoot back up to the surface. That's what's happening with silver. Every time selling pressure, often from algorithms, tries to push the price down, this immense underlying buying pressure from the physical market makes it pop right back up.
Now, for a moment, let's talk about a key signal that professional investors watch like a hawk. It's called the gold to silver ratio. It's actually really simple. It just measures how many ounces of silver it takes to buy one single ounce of gold. Think of it as a sort of health check for the precious metals market. And historically, when this ratio starts to fall, meaning it takes fewer ounces of silver to buy gold, it has been a massive green light for a major silver bull market.
And guess what? That is exactly what is happening right now. The ratio has decisively broken below a key technical level of 73, and as of this recording, it's sitting at 71.9 to 1. Now, for people who study charts and technical analysis, this is like a starting gun firing at the beginning of a race. It's a clear, historical signal that silver is beginning to outperform gold, which is a classic signature of a strengthening bull market. So, you might be wondering, if there's so much buying pressure, how is the price being contained at all? Well, some market observers point to a very shadowy practice known as spoofing. It's an illegal trading tactic where traders place enormous, fake orders to sell, with no intention of ever actually selling. The goal is to create a false impression of massive supply, which scares other traders into selling for real, pushing the price down. And according to many who watch this market closely, this kind of activity has been a recurring feature in the silver market for years.
These concerns over market practices and price containment all seem to point to one central location, the Comex. That's the main exchange where silver futures are traded. It's basically the nerve center for setting the global price of silver. And very recently, a highly controversial and mysterious event took place there that brought all of these tensions to a boiling point, a complete and prolonged shutdown of its main trading platform. So let's just walk through the official timeline of this very strange event. First, the Comex trading platform goes completely dark for nearly 11 hours. The official reason given was overheating. Okay. Now, during this blackout, thousands of futures contracts, 6,186 to be exact, are settled in cash, not with physical silver. And then, at the very same time, a massive stockpile of 13.4 million ounces of silver held at JP Morgan is suddenly recategorized, effectively taking it off the market and making it unavailable for delivery. The timing of it all is, well, let's just say it's interesting. And this is precisely why the official story didn't sit well with a lot of people. First, the data center in question reportedly had a triple redundant cooling system. A simple overheating shutdown just seems unlikely. Second, no other clients who used that very same facility reported any problems at all. It was just the Comex. And third, for many observers, the timing of that massive silver recategorization, taking millions of ounces off the table right when the system was down, it just felt a little too convenient.
This whole series of events, the price action, the premiums, and especially the Comex shutdown, has created a deep, deep divide in the market. It has led to two completely different interpretations of what is actually going on behind the scenes. And this is where you can really see that divide. You literally have two camps looking at the exact same set of facts and drawing completely opposite conclusions. On one side, you have many retail investors and market analysts who connect the dots, from the allegations of spoofing to the weird price action to the mysterious shutdown, and they see a clear, undeniable pattern of activity designed to suppress the price of silver. But on the other side, you have the institutional view, which says these are just complex but ultimately routine market operations.
They caution everyone against reading a conspiracy into what are just the everyday gears of the financial machine. And to be fair, the institutional side has been very direct in its response to these concerns. For example, CPM Group, a well-known market consultancy, publicly addressed the rumors swirling around the shutdown, and they characterized all the speculation as being both silly and nonsensical. This really just highlights the deep chasm that exists between these two worldviews. They're not even speaking the same language. And all of this, every single piece of data, every quote, every mysterious event, it brings us right back to where we started. It brings us back to a market that is fundamentally defined by this conflict, a place where the central paradox is finally coming to a head.
It's the story we began with. You have this undeniable, unstoppable, irresistible force of global physical demand. It's a tidal wave of buying that we can literally see in the dealer reports and feel in the massive premiums. And it's crashing head-on into the immense, deeply entrenched structure of the paper market, the immovable object. And this leaves every single person who is watching this market, everyone who is invested in it, with one final pivotal question. It's the oldest paradox in the book, but it's playing out in real time with trillions of dollars on the line. When an irresistible force meets an immovable object, what gives way first? Will it be the unstoppable physical demand from around the world, or will it be the established paper price structure that has governed this market for decades? The answer to that question is going to define the next chapter for silver, and maybe, just maybe, for the entire financial system. That's the signal we're watching. Thanks for tuning in to the Bullion Signal Podcast. If you found this analysis valuable, please like, share, and subscribe so you don't miss our next episode. Now for the disclaimer. Please remember, the content in this podcast is for informational and educational purposes only. It is not financial or investment advice. You should always conduct your own research and consult with a professional before making any investment decisions.